All right, let's dive straight into this explainer. Today, we're unpacking one of crypto's absolute fastest growing tokens that just pulled off something genuinely remarkable. If you've been actively watching the markets lately, you already know the volatility out there is just intense right now. But the story behind Hyperliquid and its native token Hype is really capturing everyone's attention. We aren't just looking at a simple price chart today, we're actually unpacking a massive financial engine.
Hyperliquid's Hype token recently smashed through to a massive all-time high of $82.43. To put that into perspective, it was literally trading in the mid-50s just days prior. That is a roughly 40% surge in a highly compressed time frame. But as you'll see as we go through this explainer, that eye-popping price tag isn't actually the most interesting part of the story. What's truly fascinating is the machinery operating under the hood to drive that price.
So to figure out if the underlying fundamentals actually justify an $80 plus token, we're going to peel back the layers of this entire ecosystem. We'll cover the $82 breakout, the US regulatory catalyst, the underlying trading engine, the token buyback machine, and finally weigh the bull versus bear case. Let's get right into it.
Starting with Section 1, the $82 breakout, and volatility in action. Understanding how this massive breakout actually unfolded gives us some really crucial context.
The sheer volatility at play here is just wild. We started around $58.52 on August 18th. Then, bam, an approximate 22% single-day gain, closing near $71.39. And the momentum didn't even stop there. It carried all the way to that all-time high of $82.43 by August 22nd. But, and this is key, it quickly pulled back to the 79 range right after. This is a vital reminder for anyone trading in this space. A market capable of explosive 20% upside moves in a single day is absolutely capable of violent moves in the exact opposite direction. So what actually triggered this sudden explosive acceleration? Well, that brings us to Section 2, the US regulatory catalyst, the Washington spark. The objective catalyst that seemingly set the market on fire came straight from Washington. President Donald Trump publicly commented that CFCC Chair Mike Selig is working to bring Hyperliquid into the United States in a fully compliant and legal fashion. The market's reaction to this was pretty much instantaneous. Hype jumped sharply following those comments, with reports showing an immediate 11% move that very quickly expanded into a 20% rally. But here is the absolutely crucial point we need to make. No U.S. approval has actually been finalized or announced. The United States represents one of the largest pools of financial liquidity on the planet, and investors are aggressively pricing in the possibility of tapping into that massive pool. But again, they are pricing in a possibility, not a completed regulatory victory. The timeline and the ultimate reality of that compliant pathway remain totally undetermined right now. Let's step away from the regulatory headlines for a second and dive into Section 3, the underlying trading engine. Because beyond the hype of the Hype token, there is a very real, very active business operating here.
You see, Hyperliquid isn't just some meme coin. It's a purpose-built Layer 1 blockchain designed primarily around bringing perpetual futures on-chain. These are contracts with no fixed expiration date. They are incredibly popular among crypto traders because they allow for fast, highly leveraged 24/7 trading. But keep in mind, with all that leverage comes massive liquidation risks. It is a very high-octane environment.
And the numbers generated by that high-octane environment are heavy-hitting. We are talking about $17.05 billion in perpetual trading volume and $9.21 billion in open interest across their 300-plus markets. Based on recent activity, the protocol's annualized revenue sits at roughly $468 million. These metrics clearly show why this ecosystem demands serious analysis. But a quick word of caution. Annualized revenue just projects a recent run rate forward. If trading volume slows down, that revenue drops right along with it. Furthermore, Hyperliquid isn't just sticking to crypto. They are actively expanding into real-world assets, or RWAs, alongside things like equities, commodities, and FX. Earlier this year, RWA open interest on the platform hit roughly $2.3 billion. This drastically widens their potential addressable market. They aren't just trying to be a crypto exchange. They are actively attempting to build out a comprehensive on-chain financial marketplace. So, with billions in volume and hundreds of millions in revenue, how does all this platform activity actually benefit the valuation of the Hype token itself? Welcome to Section 4, the token buyback machine. This is perhaps the most fascinating part of the entire ecosystem. It works kind of like a giant vacuum. First, platform activity generates fees. Next, an astonishing 99% of that protocol revenue goes straight into an assistance fund. That fund then automatically buys hype tokens right off the market. And finally, those purchase tokens are burned, meaning they are permanently removed from circulation. Theoretically, if platform usage keeps growing, this creates continuous structural demand for the token while simultaneously shrinking the supply. However, it's definitely not a guaranteed path to price appreciation. We have to keep a very close eye on the supply dynamics. Hype has a maximum supply of 1 billion tokens. You have to watch out for supply pressures like future token unlocks, staking dynamics, and treasury activity, because if the token supply expands faster than the buyback machine can burn it, the price is going to struggle. Additionally, there's the new HIP-3 update to monitor. This replaces their heavily discounted growth mode with deployer fees that could be up to 3 times higher. It's a really delicate balancing act between boosting protocol revenue and potentially driving away users by jacking up the costs. All right, with all these complex mechanics laid out, the volatility, the regulatory hopes, the revenue engine, and the tokenomics, we arrive at Section 5, the bull versus bear case, weighing the future. To truly understand its place in the broader market, it's really helpful to compare Hype to an established giant like Solana. While Sol is built on the thesis of being a broad, general-purpose ecosystem for apps, DeFi, and consumer payments, Hype is entirely different. The Hype thesis is laser-focused purely on becoming the ultimate, dedicated on-chain financial infrastructure. They aren't trying to do everything, they're just trying to own trading. Ultimately, this leaves us with 2 very distinct paths forward. The bull case envisions Hyperliquid actually securing that compliant U.S. access, seeing rising volumes and RWA expansion, which in turn fuels absolutely massive token burns. In this scenario, they steal significant market share directly from centralized exchanges. The bear case, on the flip side, warns that if regulatory progress stalls or if volume falls and leverage aggressively unwinds, the selling pressure from token unlocks will vastly outpace demand, triggering a severe correction. The next phase for Hyperliquid is no longer about generating hype. It is entirely about proving the economics. Can the underlying business actually outrun the soaring expectations? That leaves us with this final, pivotal question to consider as we watch this story unfold. Is Hyperliquid truly evolving into a genuine, foundational piece of global financial infrastructure, or is this simply another spectacular, fleeting crypto trade? Keep an eye on the volume. Watch the regulatory tape and track the burns. That's exactly where you'll find your answer.